Okay, looks like we're up live and recording. Just to begin, make sure that we are. Okay, all right, so we're live and recording. So let's get started. Oh, JT, can you hear me? So I'm not sure who can hear me. Okay, sounds good. Let me just check my Discord real quick. Okay, yeah, so the purpose of this webinar, we're going to be talking about options, what they are, how they work, all that. So let me get started. I'm going to share my screen. I created a PowerPoint presentation. Hopefully this works. I think people are still logging in. I apologize for that noise. I wish I could take that off. Okay, let's do this. Share. Okay, can you guys all see my screen here? Okay. All right, so let's get started. Slideshow from the beginning. So basically, I'm going to be walking through everything you need to know about option trading. I'll be sending you guys the recording and the link at the end of this to the PowerPoint. Everything you need to know is in here. So this is option trading. Let me just, okay, I think it just shut off. Sorry about that. Just a quick second. Just a second here. Looks like we're having a if you guys have any questions, by the way, drop it in the study room. Okay. So, I think just one more person needs the link. Sorry about this. A lot of people in here. Somebody drop the link. All right. So let's get started here. I think we have, yeah. Mute. Okay. All right. Let's get started with the presentation. Okay. So here we're just doing option trading. It's brought to you by Alpha Trades and me, which is R2K Trading. Of course, it's gonna shut off again. Please continue. Yeah, I'm sorry about that. I would do that. Let me see. How do I mute that sound? Yeah, I apologize for that. There's no way to mute the sound, but sorry, we're just gonna get started. Okay, so screen share. Yeah, I muted all of them on entry, but it doesn't mute the sound. So I apologize for that. Okay. You guys can all see my screen, right? Just drop a yes. Okay, good. All right. So this is option trading. Basically, everything you guys need to know about option trading is brought to you by Alpha Trades and me, R2K Trading. So let's get started. So what we'll be covering today is what is option trading, how to conduct option trades, what calls and puts are, how to use them, everything corresponding to them, examples on Robinhood and Webull, tips and personal recommendations. All right. So all right, so option trading is for anyone who is looking to maximize profits, anyone who has experience trading and can utilize risk control as they're very volatile. They can your losses can exceed your profits, but that's if you use them the wrong way. Here I'm gonna teach you how to use them the smart way and how to utilize them to the fullest. Is anyone who can handle losses too. We don't want any revenge trading here. Okay. So this is an example. I had a Boeing call this week. You see on 6/4 right here. I bought 4 call options for Boeing at 305 strike on August 21st. You can see that somebody here, they had a 165% return on that. So that means however many contracts they had, they almost doubled it. This happened for that call. This happened for other people as well. Uh, I personally had a 300% gain on it, so I tripled my portfolio there. Let's see. I also had an AMD call a few weeks ago. Not a few weeks ago, about a week or two ago. Same thing, 118% gain. I had another one, another Boeing call that I did the same day, had another 120% gain, I believe. So this is what option trading is. You can see that you maximize your profits. You put in um, almost $700, right? He just put in $700, 4 contracts on Boeing, and he came out with $1,000, $1,068. So his total value was 1712. All right, key terms. So option is choosing whether a stock goes up. It's call a call or put. It's whether you're betting it's going to go down. That's a put. Going up is a call. The strike price is the price a stock can be bought at when exercised. So we're going to explain that basically. The break-even price, let me move this chat out of the way. Sorry about that. The break-even price is the price the stock must surpass in order for you to purchase the stock at the strike price. What that means is by the expiration date, right? The expiration date is the date the option expires. So when you go into your option, you choose whether it's August 21st, whatever it is, you choose your expiration date. And what that means is that by that day, if the option is not above the break even price, that means that it expires worthless. You lose all your money you put in. Premium is the price you pay for the option. It's the price you see times 100. So if it's, the premium is $5, you pay 500 for the whole contract. So buying an option means that you're purchasing the bet at a certain price that's going to go up. Selling an option means to sell it. Exercising, we just talked about that. That's basically when the stock surpasses the break even, you can turn it into shares. So let's say the break even for a stock is $7, right? And you pass it. It's the expiration date. Today is August 21st, and the stock is at $8. You surpass the break even, so you can contact your broker. Well, it'll automatically be exercised, but you pay $700, and then you get the 100 stocks, and you can immediately flip it for 800 for a profit of $100. Now, you don't always have to exercise an option. I don't recall a time that I've ever exercised an option. I never hold it that long. Time decay, this is the one main problem with options. It's that the closer you get to the expiration date, the less value the option has. So we have all these terms, but they're very difficult to remember. So let's take a look at how these terms apply. So you can see on Robinhood right here, we have an example of a call, right? So this is for Boeing. You can see that we have a call, put, buy, our typical screen. So this right here is the break-even price. This is the price the stock has to surpass by the expiration date, or it doesn't even have to be the expiration date, for you to purchase it at the strike price. So this right here is the strike price, 220, right? The price that it can be bought at when exercised. But what this is saying, let's say Boeing is currently trading at $200, right? Right now it's at 205. It must pass 241 in order for you to be able to buy it at 220. Now keep in mind that's it's pretty much unrealistic that you're going to exercise this option because you're paying 220 times 100. So you're paying close to $22,000. But then you'd flip it back for 24,000 for a profit of 2,000. If depends if it's at the break even or past it. Expiration date, this is you're not required to hold it until then, but if you do, the stock price is not above the break even price, it expires worthless. So you would lose all you put into the contract. Now, we were talking about the premium here. This is the price you pay times 100. So you see how it's $25.50? You would pay $2,550 for this contract. This is for one share. You always have to buy it in 100. So the option is basically your option. You're weighing your option. It's whether you choose the stock will go down or it will go up. So in this case, this is a call. So we're saying that the stock will go up by September 18th. We're going to choose our strike price and we're going to go from there. Down here, we have the percent change for the day. So you see we have 74.9%. That's how much this price rose by today. So this was probably originally, probably around $15 or so. I'm not really sure about the calculation, but you get what I'm saying here. So here we're looking at two screens here. We have a June 12th expiration and we have a September 18th expiration. So what's the difference? You can see here that the one that's much closer, we have a very small dollar amount. This is like $7.20. Well, not very small. You would pay $720 for this option, right? Now over here, you pay $2,550 because the closer you are to expiration, right? Today is June 7th. That means within 5 days, you pretty much, the stock has to go up. It has to reach the break-even price. Now, that's not totally impossible, but it's more possible that it'll reach above 210 within about 3 months. You get what I'm saying? Just check the chat. All right. So the closer the date is to expiration, the cheaper it is, as it's less likely that the stock will reach the strike price by then. See? So here, it's less likely that it might reach 210 rather than in about 3 months, which is what I was just talking about. All right, so let's take a look at what happens once you purchase an option, right? So when you purchase an option, you're going to get this screen. You see you have your Boeing price at the top, and you have everything here. You have the Greeks, you have everything like bid, ask, mark, all this. So let's talk about what all these things mean down here. So theta measures the impact of a change in time remaining, right? So this is saying that for every dollar that the stock moves, right? So if it goes from 205 to 206, your option will go up from 3.11 to 3.21, right? So in perspective, what that means is, so say this was the price I bought it at, 3.11, right? So 3.11 times 100, that means that's worth $311, right? So if the stock goes up $1 to 206, and this goes up a 0.1 to 3.21, now I'm worth $321. So that means I just gained $10. Now, this isn't exactly realistic because these change all the time, especially with a stock like Boeing, and you see how much action we had in the past week. As volume grows, these numbers can inflate like crazy, especially Delta. Vega measures the impact of the change in volatility. Delta is the impact of a change in price of the underlying. Gamma measures the rate of change of delta, and rho measures the option sensitivity to interest rates changing. Now, these aren't too expensive, or not too expensive. These aren't too, you don't have to know these really. Once you just have them here, because you're not really calculating it out, you let the option calculate it for you. You can also use, which I'll show you later in this presentation, it's called Option Calculator, or optionprofitcalculator.com. You can use that, and you can actually calculate how much it'll go down, how much it'll go up, pretty much. So we get this screen, right? We purchased our option. So what does all this stuff mean? So this was off my Boeing call, up 420. This was just recently. So the number of contracts or call options open, you have 7 here. The break-even price is $327. So once again, that's the price the stock has to surpass by the expiration date for me to be able to exercise it, for me to be able to buy a hundred shares of it at 325, which was my strike price. But I don't have any intention of doing that. I just chose this price because it was pretty cheap. It was reasonable. You don't have to pay $2,550 like some of the other options, and it still moves up. You can see that. So this is my equity. This is the total value of the call option. So that's the initial investment plus the return. Okay. So I paid about $1,700 for this contract, right? For these 7 contracts, and that's plus the 420. So that's how much that's worth. Okay, so expiration date, you see we have 9/18. This is the return stats. The history of the call option, so the previous close, it was at $1.45. The next day it was trading around $2.50. Now it's at $3.11. It's actually shot up to about $5.07 that day. So the current price of the option and the average cost of the calls. Okay, let me just check the Discord really quick, make sure. Okay, let me just send the link out really quick. We still have some people that I guess did not receive the link. All right, drop a note in the chat. Do you guys understand everything so far? Okay, so 100 shares, where that comes from is that whenever you purchase a contract, right, whenever you purchase a call option, you have to purchase 100 shares. Okay, it's not optional whether you just purchase one share because it's a contract. So right here, 7 contracts. That means I'm actually controlling 700 shares of Boeing. So pretty much, yeah, one contract equals 100 shares. No, it's not for Boeing only. It's for every stock. So any stock that you trade an option on, it's 100 shares. Now, what this means is that that was definitely out of the money. I'll explain that in a little bit. You don't have to keep the option till expiration date. Okay, the cost was 3.11 because it just went up. Right? I will answer some more questions closer to the end once we get through the stuff. But pretty much, so we have 700 stocks we're leveraging. In other words, what that means is that I'm getting the return from 700 stocks. Now we know Boeing trades at about $200. So 200 times 700, we're looking at about like $140,000. I think I calculated that right. Not sure, but that's how much we're leveraging. So I'm getting basically that return out of it. Okay, so it's better because obviously I paid $1,700. I'm leveraging 700 shares of Boeing, and I'm getting that return. Now, the other problem, you're like, well, there has to be a catch. Yes, there is a catch. The catch is that your loss is with 700 too. So if that goes down $1, you're taking that hit on the 700 shares. Now, the advantage to this is that, obviously your profits are very much maximized, but your advantage is that if you put in $1,700, that's the max you can lose. You can't lose any more than that. And very rarely have I ever cashed out an option where I was completely worthless. I'd say the least I've ever cashed out for is like if I put in about $300 in an option, the least was about $60. But that's why you don't put all your birds in or all your stones in one bag. That's basically what's called. Or not stones, all your marbles. You know what I'm saying? It's like a bag. All right. So key points. You can only lose as much as you put into the option, right? If you put $700, that's the max you can lose. Here, if you pay a $353 premium for one contract, that's the max you can lose. Options are very volatile. Thus, with larger gains come larger losses. The stock does not go in the direction planned on. So if you do a call option, you're saying the stock will go up and it goes down. That means that your losses are going to be basically major. If it goes down, if you put a put option and it goes up, same thing. You cannot trade options after hours. It's only between 9:30 and 4 p.m. Oh, boy. Somebody. Okay. Yeah. So I see you guys, you're all commenting questions in here. Yeah, just keep the questions until the end because you can only lose the cost of one. Yes. Uh, of the option, correct? Yes, that's correct. But let's keep the questions till the end. Try not to put them in the chat because then it's going to create noise for everybody else. So you cannot trade options after hours. Also, they do not move after hours. So if the price of Boeing goes up from like 205 and it's at 210, right? You might be looking at it, you're like, why didn't my option go up? Well, options don't go up after hours. As soon as pre-market hits, though, or not pre-market, as soon as the market opens, that's when your stock price will raise or go down. It will reflect the changes during pre-market. So you do not have to wait till expiration to sell a call option, nor do you have to exercise it. And I want to emphasize that. Okay, I've I've very rarely, I think there was only 1 or 2 times that I've exercised an option. Okay, you don't have to wait till expiration. So I chose September 18th. It's very unlikely that I'll hold it until September 18th. I mean, I'm pretty sure by September 18th that the stock price of Boeing would go up to $300 or so. But like I said, it suffers from time decay. That's very close to expiration. I wouldn't make that much money. I'll show you why. I might actually sell it soon, maybe this week, and buy back on a dip. Yeah, the option market, it opens with the market at 9:30 a.m. Right? So how much can my profits and losses be? So let's take a look at that. For this, we're going to use optionprofitcalculator.com with the long call option. Once again, you guys will receive all these slides at the end, so don't worry about that. So we have a long call calculator. This is what we're dealing with right here. So the underlying stock symbol, that's Boeing. The current price is trading at 205. I just hit get price. So the first step, you want to fill in the stock symbol. Second step, select the option. Whether you're buying it, writing it, don't worry about that. We're just doing buys for now. So for this example, we're going to be using my trade of 7 contracts at 325 strike, expiring September 18th, but I purchased them at 2.51. But I'm going to be using the current price of this, although I purchased them at like 200, or I purchased them like really way cheaper. Okay. So the first thing you're going to do is select your expiration, right? So 18th of September. Second thing you want to do is select the strike. So it's 325 strike. You see how this is 3.36? Well, obviously, I want to use 2.51. This is a coincidence that 2.51 is here. So we're just going to enter that manually. So you see I entered it manually here, 2.51. 7 contracts, so my cost was $1,757, like I said. So we're going to calculate it. All right, so this is what we get. We get this big graph. We want to make sure that down here says profit and loss. So let's look at what our profit and losses could be, right? Let's break this chart down. So first things first, notice how time decay affects the option, right? So if it hits 325 on June 7th, my $1,700 would turn into $26,000. But if it hits that on September 15th, look, that's $3,255, right? So you see how it just goes down as you go right on the graph. Let's see. So please note that you see on the side here where all these negative numbers are, don't panic. All that means negative 1757, that means that I lose what I put in, right? Because it did not hit the strike price. Now, once again, I am not planning on holding it till expiration. That is very far out. People even, a lot of times, like if you looked at on June 5th, Friday, a lot of times that stocks go down is because everyone dumps their contracts on the Friday because it expires then, June 5th, right? That a lot of people bought the contracts. They went up the most because it's the most short term and the stock moved the most in that time, right? But so like same thing you'll see this Friday, June 12th, you see closer to the end of the market or throughout the day, the stock usually always goes down on a Friday, not all the time. Okay. So right now we're looking at this graph. Let's take a look at something else. So you can see here, right? This was Boeing on that day. It hit a price of $217, right? So that's up $33 on the whole trade, right? Because I bought it the day before. It's up $33 from the day before. So I sold it at the peak right here at $217. So let's see, what was my profit on that? So if we take a look at that, right, $33 more would put me at about $238. That's between $36.54 and $28.21. Remember, I put in $1,700. This is just profit. This isn't including the equity. So that's without the $1,700. Okay, so let's calculate that. So we took them in the middle, right? We take the average of these two. So my return on it was $3,200, right? So my account balance, if it was originally 1757, my account balance was 49.94. That's the case for many people, because anyone who went on my calls, they mostly tripled their balance or doubled it. So that's how you get these crazy big returns on options. So how big could my losses have been though? Obviously I made what, $3,200, but what if the stock didn't go up? What if it didn't go up to 217? What if it went down to, like 185 or something? Let's take a look at that. So say instead of going up 33, I went down 33. That would put the stock price about 172, but I'm just going to use 175 for the example. As you can see, I would have lost negative 1309, so negative almost $1,300. So my account balance would have went from 1,700 to $400. Now you're thinking like, well, does this really make sense? Like, I could lose a lot of money. Well, we understand that, but there's ways you can avoid this. So how can I avoid such a big loss or loss due to time decay? Once again, time decay, as you can see, as you go across the graph, it's how much you can make even if it reaches the same price. So if it reached 265 on June 7th, just to reiterate, I would make 8,000. If it reached that on August 22nd, I'd make I think I'm looking at the wrong line. I'd lose $203 because the further out you go, the closer you are to expiration, the more you suffer from time decay. That's why that's why those call options for June 5th are cheaper than any other call option, because they suffer from time decay. They're decaying as you buy them on the market. So how can I avoid such a big loss or loss due to time decay? So let's just look at this. These are just my recommendations. 1, choose an expiration date at least 2 weeks out. Okay, so you don't really have to worry about time decay if you're trading short term, meaning I'm buying the contract today, the call option, I'm selling it tomorrow. Now, one thing I want to reiterate is that buying a call option in the morning, selling it on the same day is 1 day trade. So what I always try to do is I try to buy a call option maybe closer to the end of the day. I mean, for those of you who don't have 25,000 in your account, I try to buy closer to the end of the day. I can see where the market's heading. I do technical analysis, stuff like that, and I can see where the stock's heading. I buy it, right? Market closes the next day. Even if I sell it, that's not a day trade. I can save my day trades. 2, trade larger stocks with less movement. These are known as FANG. It's known as Facebook, Apple, Amazon, Netflix, and Google. So basically, as you can see, like when Apple was at its prime, or any of these stocks are, before coronavirus and all that, they were very like flatline almost. They trade between maybe about $20 a week. Like they don't go up and down that much. Therefore, they don't fluctuate that much. That means you don't lose that much on options. That's why I chose Boeing for my call option, because as you can see, it's very unlikely that, we would have hit like $175. It's very unlikely that it would have dropped that much unless something else hit. So that's why you always want to trade larger stocks. Biotechs are very risky, right? So let's not take a look at biotech. Let's look at Genius, right? So Genius, right? A lot of people invested in that. You saw how it went from $11 to, I think it was about $4 really quick. That, if you had a call option, although you can't trade options on that, if you had a call option on that, it would have automatically been worthless, right? So one thing you want to do is try to avoid biotechs unless it's something, major. So like how DVAX came out on that Friday, I believe, that there was going to be a vaccine, 99% cure. I just bought the call options for the Monday because there's a mania phase. We talked about that phase already. In Alpha Trades 101, there's a mania phase. So the prices drove through the roof because of that. You know, um, it was just the hype. That's the only thing I do with biotechs. I just write it up on the hype, and as soon as the hype is done and news isn't really being released anymore, it starts to die down. Now with DVAX, they do have trial 3, I think, coming up soon in the UK where they're actually doing testing. So I'm not too sure. I'm pretty sure the stock would go back up, but I sold out my options because I don't want to suffer from time decay, and I had them for June 19th. So my third tip is avoid buying options that are too far out of the money. Now you're saying, what does that mean? So let me explain. So, you see some options are worth a cent. What does this mean? Let me skip this slide for a second. Let me show you guys what this means. Okay, so I think right now, okay, let me head over to Robinhood. Let me show you guys what this means. Can you guys still see my screen? You guys can see my screen on Robinhood? Okay, good. So right now I'm doing the $500 challenge. So you can see I'm holding my Boeing calls over the weekend. So let me show you what this means, right? So when you view the options, so you see where this share price is right here. Anything below this is considered in the money because it's at 206. The strike price is 205. That's in the money. It's under it. Anything above this line is 206. Anything above 206, the share price is out of the money, right? So what I mean by not buying something too far out of the money, let's go to like October, right? So as we scroll up, you can see down here at the share price, this is how much it would cost, right? $32 per share. So I'd pay like $3,200 for this contract. Now, if I scroll up, you see here, these are worth a cent, right? These are worth 54 cents. So you see how much cheaper they are. I would pay $50 for this option versus, almost like I would pay, compared to like this, $122, I'd pay $12,000 for this option, right? Just check my Discord. Oh, okay. Hold on. I see that. Sorry. Sorry about that, guys. Somebody had replied yes when. Okay. Sorry. I guess you guys are still stuck on my comment. Yeah. Sorry about that. All right. Can you guys see my screen now? See? Okay. Thank you. Sorry about that. I thought it switches automatically. All right. So let's just go back from the beginning. I'll explain everything. I seriously apologize for that because I asked if I could see my screen and somebody said yes, so I didn't look back at the chat. All right. So see, we have this was I was doing the $500 challenge. We're at 2,200 right now, so you can see my Boeing calls. So here, I'm going to explain what all this means. So we're going to view the options, right? Anything below this share price line, so you can see it's at 206. Anything with a strike price below that is considered in the money because it's less than the share price. Now, anything above is considered out of the money. Now, what I meant by this on the PowerPoint, let me switch back to the PowerPoint. What I meant by not buying options too far out of the money is, okay, so let's go back up. Let's go to about October. So if we scroll up, you see how much cheaper the options get. So if I were to buy, a call option at $500, that's 51 cents. So I'd pay $51 for this option. Now, if I scroll down and I bought it at $100, I'd pay close to $10,000 for this option. So that's $50 versus $10,000, right? Obviously, you'd be like, I want to buy the cheaper one, this one for 51 cents. You see, it had a 88% change that day on Friday, that was up 24 cents. But you don't really want to buy this option too far out of the money because if the stock price goes from 206 to let's say 200, this is the first one that will get hit and it'll come down like a gradient. So you don't want to buy them too far out of the money. Same thing here. You might be looking at this one. Well, this is a cent, right? I'd pay $10 for this contract, right? That's not the case, and we'll go over that just now. So that's why I chose September 18th, about 325. You'll see my contracts appear. See, it went up $1.66 that whole day. 100% change. I had more percent change than, obviously you see most of these, you're like, oh, I could have had 172% change with 335. Well, you don't know how much it's going to change. You don't know which one is going to change the most. But I still had 100%, over 100% gain, which I'm up right now. But this is how I choose it. I just chose something that's reasonable, right? By September 18th, the stock price could potentially hit 325. If I go to Boeing, you can see that if I go over a year, its all-time highs, like where it was trading at, is about 350, 380. Like it even hit 400 at one point in time. Of course, it declined a bit, but it's not unrealistic. So it's not unrealistic that it might hit 325 by then. But once again, I'm not going to be buying the 100 shares. I'm just writing it out. Okay, so let's head back over to the PowerPoint. Okay, so those are my tips. One, choose an expiration at least 2 weeks out, unless you're very certain about a move. Actually, let me just go back to the screen real quick, and I'll show you exactly what I mean by that. So when you view the options, right, you can see these had the biggest change. This had 200%, 247%. So I'm pretty sure whoever bought this, right, and it was when it was at 217, they probably had like a 500% return. Now, June 12th wasn't a bad. It's not a bad expiration date. The only reason I didn't choose June 12th, I wasn't exactly 100% sure that was going to go up so soon. I didn't know it was going to soar that high. But if you had a call option, or even if you had one on June 5th, that would have been up a lot. You probably would have made 6 times the amount of money that you made. So do you suggest to take up a long strike date? Yeah, I suggest to take up so today is what, June 7th. So say the market opens tomorrow, June 8th. I would suggest taking it about 2 weeks out if you're short term, if you're trading it short term. So I would at least choose June 26th, right? That gives you some time. So even if the stock dips down, it always returns to its norm. So you see, Boeing's a big stock, right? Which one do you prefer to buy? Out of the money or at the money? Definitely out of the money. At the money is really expensive. I paid like $700. Out of the money, you can have more contracts, right? So let me explain what I mean by this. If I go to September 18th, right? So say I bought this one, right? This is 16 or 1745. I could only purchase with the $1,700 I had. I can only purchase one of these call options, right? Screen is blurred. Can everybody see my screen still? Okay, it might be your internet connection. All right. So you can see here we have 1745. That would have been $1,700, $1,745. Now I paid $325 up here. Yep. Or not even 325. I paid 251. So I paid $250 per contract. Now, sorry about that, blurry. Uh, so 250, right? So I bought 7 contracts with that money. If I once again, what I was saying is I would have only been able to buy one contract. Well, what's the difference? My percent change, you see, I would have gained pretty much the same, 86%. It's still around the same range, but that would be one contract versus 7, meaning I can sell out 3 of those contracts and still keep 4 if I want. I don't have to write. So if it hit, let's say it hits 230, right? I can sell out 3 of my contracts and just write out 4 of them. I don't have to sell all of them. Let's see the chat. Okay, it's your internet looks weird. Sorry about that. Yeah, so let's head back over to the PowerPoint. Does that make sense? Basically, I like buying more contracts because I like buying more contracts because you can always sell them out, right? If tomorrow it hits 230, like I was saying, I can sell out 3 of them. I don't have to keep all 7 of them. But if I have that one contract, I have to keep that one or it's nothing. All right, so let's head back over to the PowerPoint. So I'm going to talk about those 1 cent options. So I see some options are worth 1 cent. What does that mean, right? Can I buy them at $10? Well, we're going to look at this for Apple, right? So you see when an option is worth 1 cent, that means it's worthless. That means that there's no buyers in the market at all. But what keeps just leaving and coming back in? Something just sorry. So basically, if the stock makes a major move up, right, these won't be worthless. So you see how this 450 call, it went from 1 cent to 2 cents. So you might be thinking, well, I could have bought that for $10 and I could have flipped it for $20. Not exactly, right? On Robinhood, it has to have an interested buyer. So as soon as you go to click on this and purchase it at 10 cents, the price of it almost goes up to like 40 cents because it's an interested buyer now. Now it has some action on that strike price. So let's take a look at how that works actually on Robinhood. We're going to head back over to Robinhood. Let's head over to Apple, right? You can see it took a major dip here. That was crazy, but it always returned back to the norm. So let's take a look at like December or something, right? Trying to find one. that has can't find one with the cent. Okay. All right. So you see how we have this one for a cent. There's no interested buyers in this option right here. Um, this would actually not be that bad of a call option. I mean, you can see that we have some interested buyers up here because usually as you move up the stock, the price of the call option is supposed to go down. See, it goes 41 cents, 35, a penny, then $1.35. We have more interested buyers in this price right here. Let's say, continuing, I want to buy it at 0.01, I want one contract, right? Review order says no one's in the market to buy this option. I hit continue. Um, I don't know why it's not doing it. Submit. All right. Usually it doesn't let it doesn't let you buy it, right? You're supposed to buy it at least. It says it'll trade in 5 cent increments. It's just because the market is closed. It's not actually submitting the order. So let's head back over to the PowerPoint. So basically, you see here, these are what 1 cent option means. They're so far out of the money that any decrease, any small decrease in the stock price would deem all these worthless. They're already worthless, right? They're already 1 cent. But as soon as you buy this, right? Say I bought this 470 call, this will probably go up to about 20, 40 cents, right? But if Apple's price, like how it dropped from 330 to 315, this would have been worthless automatically because it's the most furthest call out. That's why I don't buy them so far out of the money. So I saw, some stocks, they have thousands of percent increase. Could I have gotten in on that? Yes and no. So you see here with Apple, this 390 call had 8,900%. Well, it's most likely that you wouldn't have been able to buy that at a cent. Like I said, when you bought it, it probably would have went up to about 40 cents. So, and you wouldn't have known that exactly this 390 call would have spiked. It's more realistic that you might chosen one of these. But even if you chose this one, you probably would have made about 100%, 200% gain. You wouldn't have made the full 8,900. That means that it was worthless before. It was a cent and it went up 89 cents, obviously. So that's 8,900% change. Okay. Yeah, volume is so who decides the option price and the strike rate? You decide that. Volume is a big play on options, right? If it doesn't have volume, right, like these, if it's not getting let me show you. If it's not getting any action, that's no volume, they're pretty much worthless. But these, they're getting made, like this one got some major volume. I'd say not major, maybe about 2 people bought it, but the more people that buy an option, the higher that drives the price. So although we have option profit calculator here, these are just kind of guesses that the volume stays the same, stuff like that. But that's very unrealistic. It usually volume can go up, volume can go down, especially with Boeing. Especially with how it spiked within the last week. People who weren't in on it, they're gonna start coming in on it this week. That's why I kept my calls. So let's do this. All right. So key takeaways here. Once again, you can only lose as much as you put into the option. You pay 353 premium. That's the max you can lose. They're very volatile. With larger gains come larger losses if it doesn't go in the direction planned on. You cannot trade options after hours. So if the stock goes down from $300 to $250, you can't sell the option until the next day still. I still think that's a good thing because a lot of times when stocks go down after hours, sometimes during pre-market, they rebound a lot. You don't have to wait till expiration to sell a call option, nor do you have to exercise it. So now I know all these terms. What do I do? So one, you want to decide whether you're betting that the stock will go up or whether it'll go down, right? So we're looking at Boeing here. Obviously, I'm looking at calls because I want to bet whether it's going to go up. So now we want to choose an expiration date. I chose September 18th just because it was a cheaper date and stuff like that. But if I was doing this short term, I probably would have chosen like June. I would probably would have chose the end of June. So if any of you are looking to get into Boeing call options, I would choose probably the end of June or early July because they have a lot coming up this month, such as NBA reopening, a lot of sports stadiums reopening. Plus, they have their 737 Max recertification. They have a lot of things going for them. So you want to choose the expiration date, choose the strike price, set a limit order, purchase it. Right? So what are the indicators for options, right? So the key indicator for options, and this is almost like a big secret, a lot of people don't know this, the key indicator is unusual activity. And I'll show you exactly what this means. People, you could have gotten in on some major gains. Let me show you. So if you look here, I saved this article in my notes right here about Oasis option traders betting on a big move for OAS. All right, this was June 1st. Now look what happened on June 5th. It spiked 167%. You could have potentially made, I'd say, about 400. Like this one. This is more realistic. You could have potentially multiplied your account balance by 4.7 times, almost 5 times. So if you had $1,000 and you invested in this, you would have came out with about $4,700. All right. So let me show you exactly what that article said. Right. You want to look out for unusual activity. So our option traders betting on a big move. You see, this was May 28th, right? So this is called implied volatility. That means that they're seeing that traders are interested in this stock, right? They're seeing that their 50 cents call had the highest implied volatility. That means that they're betting that something's going to happen. Like that's what it means by unusual activity. And the reason you want to pay attention to that is major because we're stock traders, right? We're here, we can read the news or whatever, but we know that there's people that know what's going to happen, right? They know that that Mark's cameras are going to be released before we even know that, and they bet on that. So that's why unusual activity is so big. That's why a lot of people went in on SRNE when they said that they had or not even they said they had the vaccine or whatever. When somebody purchased, I can't remember how many, but they purchased a lot of shares in their own company. It's very unusual for somebody to spend that much money on a stock without knowing what. Like, let's put it this way: if you had $100,000, would you put $100,000 in on a stock if you had no idea where the stock would go? Especially, this is a penny option stock. Like, I'll pull it up right here. Like, you can see Oasis, like, it's on the top movers page. This was trading at about, like, let me show you. This was trading at like 50 cents. You wouldn't put $1,000 in on 48 cents or so if you didn't know that was going to rise. So they knew something was going to happen. There's no doubt about that. Let's head back over to the PowerPoint right here. So like I said, you see, this was the unusual. I got this article. I saw that they're betting on a big move. You can see that it spiked way high. Like it spiked 167%, went over that. So who decides the option? What is 100% return on the option? Or when are you more likely to hit 100%? 100% means that if I put in $1,000, I come out with $2,000. I gained $1,000, right? So 476%, like divided by 100, that's 4.76. Multiply that by whatever you put in. That's 4.76 times 1,000. I'd make 4760, right? It is very likely to hit 100%. Most of my call options, I hit between 40, 60%. But every once in a while, like Boeing and all that, I hit 200%, 300. Is there a way to be alerted when implied? So you don't always see this. Sometimes Webull, which I'll explain, shows unusual activity. So let me go through this and I'll show you guys a little bit more. All right. So we have this. We took a closer look at advantages of Webull over Robinhood. It offers way more options, right? Better stock view, you can do technical analysis, and it has many tools right there. You can purchase options better. Sometimes you don't have to use that 5 cents increment. Sometimes you can purchase it at a cent. It's way more powerful than Robinhood. Even if you don't use it actively for trading, it's a very powerful tool. I would definitely recommend signing up. I'll show you everything about it. If you would like 2 free stocks worth $14.50 plus and a 2 free week membership to my server after the free period ends, you can sign up to Webull. I'm not advertising my Discord really, but it's free. I just created it. This was for another thing. Sorry about that. You sign up for Webull. You deposit $100. After you open the account, you'll receive 1 free stock, and when your deposit of $100 clears, you'll receive the other. So on the last slide, right, I have my invitation link. If you use that, you'll get 2 free stocks of $14.50 each. It's your choice. You can deposit the $100 and you could sell those stocks and you could just withdraw it right after. So you can go in with $100 and come out with about $129, but I got stocks that were worth about $80. So this is what Webull looks like, right? You have this big view right here. So these are your stocks on the left side, right? These are your indicators, you place your orders. So I'm probably going to end up doing another video on technical analysis and stuff if, you guys think that this was really helpful. So this is what Webull looks like. You can see the stock, see candlesticks. I could do another video on how to read candlesticks, stuff like that. Let's read the chat. So if you cross, okay, how to obtain consistent small profit with options. If you cross the strike price and premium, does it mean you're way above 100%? Yes. I mean, pretty much. If you cross the strike price and the premium, you're way above 100% because you're paying now the premium, now the stock price is included in the option. So you're definitely way above 100% at that point. How to obtain consistent small profits? Well, this was more of like a beginning kind of options video, but I guess I'll try to explain a little bit more about that. Once again, the main thing is you want to trade the bigger stocks. If you trade bigger stocks, you can get small, consistent profits, about 20-30%. And one thing you want to do is diversify. You want to have like, you don't want to put everything in Facebook. You want to do like Facebook SPY, which is a collection. It's an ETF collection of a lot of companies such as Amazon and other stuff. You want to split up, the calls. You want to use like Amazon or, Netflix, Facebook. Like if you do 3 calls, you balance it out, you diversify it. So even if one goes down or so, you won't be completely you won't be completely lost, but you'll still gain small profits from it. And 20%, 30%, that's big on on your account return. So say, especially if the market's a really green day. So say today the Dow went up 600 points and those stocks raised by a couple dollars, your account portfolio could be up by 100%, 200%. And the best part is you already diversified your portfolio. You have 3 call options for 3 different stocks, and if it went the other way, and one went down, you're not totally losing. So diversifying is a main thing. I know right now I have a lot of calls on Boeing. This is my small account, so I didn't do a lot of calls, majorly. This is my $500 account. So let me show you the next slide. This is what it looks like when you buy options, right? You have your strike, your price, and all this. It can be a little bit confusing, but what I like to do is I like to go over to Robinhood. So let me show you guys a live example, right? I'm going to pull up Webull right now. So this is Webull, right? So I'm looking at Boeing. So let me go September 18th, right? Looking at all the strikes, 325. You can see right now it's about 3, that's the last price, 3.2, right? So let me show you, this can be kind of confusing. Let me show you how you can utilize Robinhood to work with this. So if we head over to Robinhood, right? Let's go to Boeing, trade options. We're looking at September 18th here, 325. So you see here, like it lays it out much nicer. You can kind of get a feel for it, like 311, all that. And then you can go over to Webull, right? You can go over to Webull and purchase your option right here. You put in, I always set, so you can see the ask is 4.2. If the last price was 3.2, I wouldn't purchase it at 4.2. I would purchase it at 3.2. Or if the stock is trending up really fast, I might put 3.3. But most of the time, I like to put it down a little bit, maybe like 3.1, because stocks always have a pullback. I mean, it might be tempting if the stock is trending upwards to, I want to buy it right now, but I try to avoid that. You don't really want to do that. Okay, so see the chat. How do you see unusual activity? Is overbought of shares indicate unusual option buying? Yes, overbuying shares is definitely indicating unusual option buying, but it can also indicate that the stock is going nowhere and a lot of people are investing. Like SRNE, right? A lot of people are investing in it, but the stock kind of went down. So that's why you never put all your money in. You want to diversify for sure. But how do you see unusual activity? Usually you want to look at the news. The news is your best friend. You want to go on Yahoo News, or you want to look at, you definitely want to monitor. Let me show you. Let's go over to Robinhood. You can go to your, front page. You can see how the stocks are moving, top movers. You can kind of get a sense of it. So what I like to look at a lot of times is you want to look at how far down it's moved, right? So if this stock moved 14% down, I might look at the catalyst, right? Like what caused that? Well, obviously for Genius, we know that they got an offering. That's why they moved down so much. I'm surprised they're back at 609. But you want to look at stocks that went down, kind of, you know that, like you see how this is a 54% buy here? That means that it's most likely going to go back up to the norm eventually. Like, see how it dipped down right here? Unless there's something else, it'll most likely go back to this $38. Um, unless there's like a catalyst. So you want to look at the news, right? So Slack talks about tailwinds and headlines ahead. So we're looking at stuff like this. But let's take a look at Boeing, right? Let me show you if I could find something a little bit better, right? Close this out. So you see here, we're looking at like Dow surges 815 points on gains in Boeing, right? So you want to see what influenced this gains. Why is Boeing going so high, right? When you see this, that doesn't mean that it's too late to go in on an option. That means that there's something happening, right? We have a 42% buy right here, 54% hold. You can see that uh, there's people see, look, the 737 Max remains grounded for a moment, which would be an overhang on. So you want to take a look. You can see that their earnings are expected July 22nd. I probably won't hold until then. It might go up, but I think their earnings might be negative. I'm not sure. It should be positive, but I think it might be because of coronavirus. But basically, after this, you want to go to like Yahoo News. You search in a symbol BA, right? And you can see like what's happening here, like you can see all the news surrounding it. But usually if there's unusual option, it'll come up on your phone or it'll be on the home page here. There's also websites that you can search for unusual option. I'll show you that in the next maybe the next webinar. It's but for the most part, what I use is this. You want to use Yahoo Finance. You want to look at how the stocks are moving and why they're moving, like especially with Boeing, right? You know that it's most likely still going to go up. I'm pretty sure it's going to pull back a little bit, but in the end, it's going to go up. This is a stock that it's an investment stock. That's what makes this so great. All right, so let's head back over to the PowerPoint, right? Okay, from the current slide. So this pretty much concludes it. Thank you for joining the session. I'm still going to go over some stuff, so don't leave yet. You can follow me, R2K Trading, on Instagram. I just created it. My Discord link is on there as well. I just created that for you can ask all the questions in there. Let me know how the session went, either in my Discord or on Alpha Trades 101. Email me with any questions at the next step for real at gmail.com. I'll be sending the PowerPoint and the webinar recording out. Thank you. Good luck trading, and use my invite for Webull for 2 free stocks. It's right here, but don't leave just yet. We're gonna go over some more things. Let's see, chat. Okay, so can you provide an example of any other shares like Amazon's on options? So that's what it's called, FANG. We're looking at Facebook, Amazon, Apple, Netflix, Google, any big stocks really, like Tesla, all that. Like one of the biggest things, Tesla had the SpaceX launch, right? It went from about 860 to about $900. Those options soared about 400%. You want to look for a catalyst, right? And here's the best part. Even if the launch didn't go successful, you still had that buildup in hype, that mania phase. If you can jump on that mania phase while the stock is going up, you don't even have to hold it till the event actually happens. Just like SRNE. If you bought the options as the news came out, you could have rode it up until then and you don't have to hold until news. I try to avoid holding until news because if it's bad news, it'll go down. Of course, if it's good news, you probably could make another 300-400%, but I'd rather take my 300-400% I have currently rather than lose like 600 or lose all my money that I put into it. Is there a website which combines unusual option activity or news only about option trading? Yes, there are websites. You can use websites such as Finviz to search for stocks. You can use I mostly use Yahoo Finance because you can see the news. And on Webull, actually, when you sign up, it alerts you when there's unusual activity. Like it'll tell you when there's unusual activity. It'll pop up on your phone. Like I'm sure some of you saw last week. Guy left it in the chat. Let me show you. I think it's paused right now. A guy left it in the chat. That Mark had unusual activity. Now I didn't go in on Mark. I went in on mark that day, but it's a very I don't usually go in on biotech. I would avoid biotech. Biotechs are very risky. Unless they have solid evidence backing them up, it's most of the time speculation or the company could be trying to boost itself. All right, let me head back over to the PowerPoint. Um, Option trading. Okay, so if you select the strike price in Boeing for 325 for 918, even though it doesn't hit 325, you're still in the money. Yeah, well, you're not in the money. You're still out of the money, but like in the meantime, right? You're still making money though, because if it goes from 325 to about, or not 325, if it went from 205 to 220, you're still gaining. So option trading, swing trading, scalping, or long term, it can be for long term. If uh, Usually not really because it suffers from time decay. So I try to avoid long term. I only use long term for the duration. Uh, we talked about call, not sell to open and put out options. Okay, I'll explain that too. Scalping, yes, you can use options for scalping and swing trading. So you reach the strike price, but not the premium. If that's the case, what would the return be? Um, well, if you reach the strike price, if you reach the strike price, you wouldn't. Let me see. I'll put this. Your return would probably be about 100%, but it would be more if you reach the premium. If you reach the break even, well, once you reach the strike price, you're in the money, so it is the premium. So it's going to be the same return. Do you primarily trade options? Yes. I um I trade options primarily. When do I recommend trading an actual stock? When it's like biotech. When it's something like a penny stock, I usually don't trade options because they're very volatile. I've seen penny stocks dip for the worst. Penny stocks are anything under $5. So call options. We didn't talk about sell to open or put options. Um, Put options is exactly the opposite. Basically, uh, you're just betting that the stock's going to go down. So let's head over to let's say Robin, right? So let's go on Boeing. Can you guys see my screen? I think you can. All right. So if you buy a put, obviously this is red because Boeing is going up right now, but usually you want to shoot. So you can see it's the total opposite. As you go up, the price is more expensive. As you go down, it's less because it's less likely that it'll hit like 185 or something like that. So puts, I would do exactly the same, but it's like the opposite direction. I would choose something far, but not too far out of the money because obviously if the stock goes up, these will be deemed worthless first. So if I were to put on Boeing, I would probably choose something around like 185 or 180ish, like right here, $142. As the stock goes down, so if it goes from 206 to about 200, then obviously you're moving up the chain. That'll probably be worth about like $2.60. Um, this is in the money. Anything above here is in the money because this is above the price, right? This is below, so it's the total opposite. That's why I didn't really go in depth about it because it's the same thing pretty much. Call, it's just calls and puts are the extreme reverse of each other. Um, so that's pretty much the same here. Let's see. So obviously you can see when a stock is trending upwards, right? The percent, obviously this is going to go down. But if you do buy a put option, I don't really recommend going in on puts if you don't know how calls work. But I mean it's the same thing, but just going down. But a lot of times the call options don't go down, which is I mean not the call options, the stock doesn't go down, and then you're left with a worthless contract. But my opinion for this is buy something like 2 weeks out and basically just ride it out. If it's soaring that day, don't sell it at the peak. It's gonna go back down, right? Uh, Most of the time. I mean, I haven't seen anywhere where I bought a put, the market opened, it was all the way up, it kept going up, and then it didn't go back down. So yes, you might lose, but don't panic and sell. That's my main advice for options. Do not panic and sell. I don't know where all these marks are coming from. But don't panic and sell because if you panic and sell, you miss out on a lot, especially with options. You will see, like, let me show you something. Um, okay, you will see if I go SPC, right? This was one that we were trading. Um, so let's go a week. So you guys remember when we were talking about this? It was building up here, right? This is on June 3rd. I had bought the call option like right here at like 15.7, and it went up to this, right? Went down, went down, and it hit about 1608, and then shot up to about 16.72. You would have missed this gain if you sold here and you didn't sell here. You would have missed that gain. And let's see how much of a difference that is. That's 10% to about 8%. That's 2% more gain, right? So, does somebody have access to drawing on this? I'm not sure where the drawing is coming from, by the way. Okay, there we go. Okay. Yeah, so pretty much you would have seen that, you would have, so one thing you want to do with options is set your loss, okay? So if I buy Boeing for 205, I'll set my loss for, let's say 180, right? I mean, that's probably, I can move it down if I want, but I set it firm, right? So I would have set this at $16, and obviously didn't hit $16, it went right back up. You want to know about support and resistance, because remember, the call options or any option, they reflect on however the stock moves. Do you ever sell to open option collecting premium? The loss can be unlimited right here, right? Yeah, so if you sell to open an option and you collect the premium, the loss can be unlimited. It depends. It depends on how much you actually put into it. We'll go in depth with that on maybe another video, because right now I'm just really trying to get people with a basic understanding of call options and put options, because they can get confused with what's happening. Do you set the stop during the buy or after you buy, and then you set the stop? I set the stop usually. So once I buy it, or I usually analyze the resistance and support regions. Like right here, you can see we hit some resistance right here. You can see this is support right here. I would have analyzed where the support and resistance are from here. So I knew that was going to bounce off about 16. So I had set my stop loss when I went up here to about 15.8, because we could see that this is a support region right here, and this is resistance up here. So I set my stop loss when I bought it here to about 15.89. So I wouldn't have walked away with a lot of money, but I wouldn't have lost that much. Options are the most risky. Yes. Is there a good options paper trading platform? I don't think Webull lets us. I think you can trade options with Thinkorswim, TD Ameritrade. That's a very complex platform though, so I'll look into that and I'll drop it in the Discord Alpha Trades. How to manage loss. So, like I said, you want to diversify your portfolio. You don't want to put all your eggs in one basket. That's what I was looking for earlier. You don't want to put everything just in one. You want to be able to have 3 stocks, right? So say I had these $2,200 right now and I just wanted to invest in a couple things, right? I would go for SPY, which is an ETF composed of like Amazon and other ones, Boeing, or not even Boeing, go like Amazon and maybe Tesla, right? So how do you close the call order? So you don't really have to close it, you mostly sell it, right? So let me show you. If I go here, if I go to my Boeing call order, right? So I would put sell to close, 7 contracts, and the limit price, right? So right now it's at 3.11. You have to put it in 5 cents increments. So it would probably be 3.1 you close it at, right? And then that's how you close it. You review the order, you submit it, you sell it. Obviously, it wouldn't process right now because the market's not open. For Boeing is 325 strike price. Expiration date is September. If the stock goes down, does the equity value? Yes, the equity value does go down, but there are some flip sides, right? So say this is 206. Say it went down to about 200. I mean, obviously, I'd probably go down to, I'd say about 2. I'd probably go down to about 2.4 ish, right? So obviously, my equity will go down. But if you have more volume, if you have people buying that option, then it'll pretty much stay the same, or it could even go up as the stock goes down. Most of the time, it doesn't, though. Most of the time, it'll follow the stock. Can I do a spread to protect downward risk? Yes, you can do spreads such as like iron condors and stuff like that. I will go over that in another video. This was just, pretty much for options, getting into options and what options are. Let me switch back. my screen. So yeah, that pretty much sums it up here today. We're pretty much done with options. Can you guys leave, comments in the Discord or on my Discord? Just, let me know how this went. You had any recommendations? Who decides the strike rate? You decide the strike rate, right? No. Oh, so you mean like the set prices? Yeah, they're usually in like $5 increments, or um, it depends on how valued the company is. If the company is trading like, Tesla, right? It's $800. It won't trade at like 50-cent increments. It's going to trade at like $5, $10, or something like that. As there is risk, we'll provide guidance what stocks to put in options as we can see gains in your options. Yeah, I will definitely put my options in. Oh, I need to disable that. But I will definitely keep posting my options in the chat. Even if you don't go in on them, I want you to look and see how they work. I'll explain why I go in an option. Especially like right now, semiconductor stocks are moving a lot, such as AMD, Nvidia, sorry, Dell, stuff like that. They're going to be moving a lot. So you want to follow the news, right? Because volume is a big factor in option trading. Another, just to mention, somebody wrote spreads up there. Another good spread. Oh my god, I don't know how this works. Another good spread is called a iron condor. Uh, yeah. So why are semiconductor stocks moving so much? They're moving so much because of the new technologies coming out, such as like with Mark, their thermal imaging, different things at like airports, stuff like that. Uh, they're actually moving a lot right now. So yeah, 5G. 5G is a great one to go in on. AI. 5G. They said that's supposed to be coming out. Right now, it's like in cities, but once it expands, what are 5G stocks? 5G stocks are like Qualcomm. Um, let's see, Qualcomm, uh, Nokia. Yeah, all those that they're listing right now. Anything that has to do with basically 5G. Anything that has to do with like connections. So Qualcomm is a big one. Um, when 5G does come out, which I do expect, right? The iPhone 12 is supposed to be releasing this year with uh with 5G on it. So I do expect for 5G to be widespread by then. So that would definitely be um a good thing to invest in. Now, I'm not sure about call options on it. I would wait maybe closer to the end of the year, because you'll suffer from time decay from now. You know, that's why I wouldn't. I would, like, if you find the stock and it's cheap right now, I'd probably buy it as a stock. I wouldn't buy it as an option. But 5G is already available in the US, but you can expand it to yeah, pretty much. It's going to expand. Like, can you hold stocks and contracts at the same time? Yeah, you could definitely hold stocks and contracts. I do that all the time. Stocks and call options, because like especially stocks like biotechs and stuff, I don't like putting in call options on them, because a lot of times the news will come out like a flash. Like it'll say like, oh, you know, it'll say like, oh, we made a vaccine like sRNA, and then next thing you know, they just walk back their statement or something like that. So I would like on something like that, I would hold a I would hold a stock on that. I would not hold a call option. All right, so I think that pretty much sums it up here today. If you guys have any questions, please leave it in the Discord. Good volume on options. It depends on the stock. Uh, but yeah, definitely we're gonna end here today. Thank you for your time. I hope you guys learned a lot from this. And yeah, no problem. Did you guys can you leave comments in the Discord? Let me know how it went, and I will email you guys. I have all your emails. I will email you the PowerPoint, and I will email you the recording. You do one-on-one session. I could probably do that. Let's see. Do you guys think more sessions going forward would help? Okay. All right, definitely. I will let you guys know. All right. Have a safe weekend. Stay safe, and have a great day. Bye.